There is a moment in every market cycle when something subtle goes wrong, long before anyone sees a chart break or a headline flash. It doesn't come with alarms, it doesn't announce itself, and it certainly doesn't wait for analysts to catch up. It begins quietly. Deep inside the machinery, traders rarely bother to understand the spread between U.S. Treasuries and interest rate swaps. A number so technical most people scroll past it, yet so revealing that the smartest desks watch it with the kind of attention usually reserved for a fire alarm. Because when swap spreads begin to tighten, or worse, flip, the surface of the market may still look calm, but the plumbing beneath it is already groaning. Imagine running your fingers along a cold steel pipe in the basement of a massive building. Everything upstairs feels normal, the lights, the conversations, the hum of activity. But down here in the dim corridors, you can hear a faint rattle. A vibration the architects never intended. A warning that pressure is building in a system designed to stay silent. That is what swap spreads are. The rattle in the pipe. It's a sound that tells you the pressure is moving, the structure is shifting, and the world upstairs has no idea. Most investors are trained to look at yields, Fed speeches, inflation prints, recession probabilities. But the truth, the uncomfortable forbidden truth, is that the earliest sign of a structural misalignment does not come from the front page of financial news. It comes from the narrow space between a Treasury S yield and the fixed leg of a swap contract. A space that should be orderly, logical, stable. And yet, when liquidity thins or collateral becomes strained, this space bends. It twists, it breaks its own rules. Inside trading floors, no one jokes when swap spreads begin to collapse. No one shrugs when the spread between the safest asset in the world and a synthetic rate suddenly compresses, because they know exactly what it means. Swap spreads don't tighten because demand for treasuries suddenly changes. They tighten because the structure holding everything together, collateral, balance sheets, dealer capacity, is being pulled in directions the public never sees. You were never supposed to see this file. That is the truth. This is the part of the system banks don't teach, textbooks don't explain, and journalists don't bother with because it feels too technical. But in the underworld of global finance, the technical parts are the dangerous parts. They are where systemic stress first appears. They are where incentives twist the market into shapes invisible until too late. Before swap spreads flip, everything still looks calm. Equities may be green. Treasury auctions may clear. Analysts may sound optimistic, but the spread is already whispering that balance sheets are tightening, the collateral chains are shortening, that someone somewhere is stepping back. To understand why swap spreads tighten and why a negative spread has always been a precursor to deeper structural tension, we have to go back to a world before anyone even used the phrase market plumbing. A time when derivatives were newborn instruments, treasuries were treated as unquestioned royalty, and dealers still imagined they controlled the stability of the system. The origin story of swap spreads isn't dramatic at first glance, but beneath it lies a series of decisions, incentives, and architectural flaws that quietly set the stage for every modern liquidity crisis. In the late 1980s and early 1990s, interest rate swaps emerged as a brilliant innovation. They allowed institutions to exchange fixed interest payments for floating ones, creating synthetic exposures without touching physical bonds. Banks loved them because swaps required no balance sheet in the traditional sense, no custody, no delivery, no warehousing. They were pure abstractions, almost too clean, too elegant. Compared to treasuries, which needed settlement, collateral, custody fees, repo financing, and market-making capacity, swaps seemed like the future. But the market quickly realized something unexpected. Swaps traded at yields above treasuries. In other words, the synthetic rate was more expensive than the rate on the real risk-free asset. That made sense. Treasuries carried the full faith and credit of the U.S. government. Swaps carried counterparty risk, dealer risk, and liquidity risk. So the spread between treasuries and swaps was positive. It was logical. It matched intuition. For almost a decade, this relationship held with remarkable consistency. Analysts viewed the swap spread as a measure of systemic health. Wider spreads meant rising risk. Narrower spreads meant stability. But stable does not mean healthy, and the market would learn that lesson the hard way. Then came the late 1990s, a period defined by deregulation, explosive derivatives growth, and a quiet but powerful shift in how Wall Street thought about U.S. Treasuries. The Treasury began running budget surpluses. Debt issuance slowed. Suddenly, the supply of treasuries was no longer expanding, it was shrinking. Dealers depended on treasuries as the backbone of the collateral ecosystem. Now that backbone was tightening. The architecture was thinning. And into that thinning architecture poured trillions of dollars of new derivatives demand. Interest rate swaps were no longer just a financial tool. They were becoming the backbone of corporate financing, mortgage hedging, speculative rates, trades, and balance sheet engineering. The swap market ballooned far faster than the Treasury market. Soon, demand for synthetic exposure exceeded the supply of the underlying instrument. A dangerous imbalance had begun forming. The first time swap spreads showed their true nature was during the long-term capital management crisis in 1998. LTCM's downfall wasn't simply about leverage. It was about liquidity assumptions. The fund believed that treasuries were always liquid, always stable, always safe. That swap spreads would obey historical patterns. That market makers would always step in at the right time. Those assumptions collapsed in real time as LTCM's positions began to unwind. During the crisis, dealers hoarded treasuries, repos tightened, counterparties panicked, and swap spreads widened violently. It looked like the system was breaking because it was. But the more important lesson wasn't the widening spread. It was how quickly spreads snapped back once the Federal Reserve organized a rescue. The architecture could be bent, stretched, even damaged, but it had not yet reached the breaking point. That breaking point would come later. In the early 2000s, something subtle but profound began to happen. The supply of treasuries increased again, thanks to budget deficits and war spending. Many investors felt comforted. The safe asset of the system was returning. But the derivatives market was now enormous, interconnected, and structurally dependent on collateralized financing. The old relationship between swaps and treasuries was becoming unstable. By 2005-2006, a worrying pattern appeared. Swap spreads began creeping lower. The market blamed technical reasons, mortgage convexity hedging, dealer balance sheet shifts, changes in treasury issuance. But beneath these excuses was something deeper. A structural imbalance between the demand for risk-free collateral and the capacity of the system to supply or redistribute it. The spread was not mispricing risk, it was signaling strain. Then came 2008. During the global financial crisis, swap spreads behaved in ways that stunned analysts. Instead of widening dramatically like they had in 1998, many swap spreads collapsed. Some even went negative. To the untrained eye, this seemed paradoxical. Why would synthetic rates fall below treasury yields at the exact moment the system was imploding? Because the crisis wasn't just a credit crisis, it was a collateral crisis. Treasuries became the most sought-after asset in the world, not because investors loved them, but because every funding chain, repo contract, and balance sheet margin call demanded them. Dealers were unwilling to part with their inventory. Repo haircuts soared. The world was not buying treasuries, the world was scrambling for survival. Swaps, on the other hand, did not require physical collateral in the same way. They required mark-to-market adjustments, not immediate custody of the underlying. As a result, the synthetic rate remained anchored while the treasury yield fell under the weight of panic-driven demand. This caused spreads to flip negative, a signal that the system's plumbing was breaking in ways the public could not see. After 2008, regulators attempted to reshape the market. They introduced mandatory clearing for swaps, increased capital requirements, and forced derivatives through centralized counterparties. And while these reforms made swaps safer from a counterparty perspective, they unintentionally made treasuries even more essential as collateral. Every new regulation increased the demand for high-quality collateral at the exact moment the system was becoming more interconnected and more dependent on liquidity transformation. By the mid-2010s, swap spreads sat at historically low levels. Analysts published papers. Academics wrote theories. But the simplest explanation was the truest. The modern financial system was now designed in a way that made negative spreads not an anomaly, but a structural possibility. Then, in 2019, the repo market blew out. Sudden spike in repo rates, driven by balance sheet constraints, regulatory frictions, and Treasury settlement mismatches sent shockwaves across funding markets. Many thought the event was isolated. They were wrong. The September 2019 repo spike was a preview of what happens when collateral demand and balance sheet constraints collide. And once again, swap spreads reacted before the wider market understood what was happening. In 2020, during the pandemic crisis, Treasury markets cracked. Bid-ask spreads widened to historic levels. Dealers refused to intermediate. The safest, deepest market in the world malfunctioned, and swap spreads tightened violently, signaling that collateral, not credit, was failing. Each crisis had its own narrative. LTCM, housing, repo. Pandemic, but beneath these stories was the same recurring truth. Swap spreads are not about yield. They are about the structural tension inside the collateral ecosystem. This is the lie people believe, that spreads are technical noise. But the leak, the signal hidden in decades of data, tells us something else. Swap spreads are the earliest systemic indicator that balance sheets are reaching stress levels the public cannot see. When spreads tighten, the system is preparing for impact. When spreads flip, the system is already under strain. And the reason this mechanism has been ignored for so long is simple. It requires combining knowledge from derivatives, treasuries, repo, and dealer balance sheet regulation fields siloed so completely that almost no one studies their interactions. But in the underworld of global finance, everything is connected. And the spread, this narrow gap between a bond and a synthetic contract, is the hinge where hidden pressures reveal themselves. Before swap spreads flip, there is always a moment of calm. A moment when headlines sound optimistic. A moment when liquidity looks stable. A moment when volatility feels manageable. There is a moment, and it happens in every cycle, when the familiar explanations stop working. Analysts will still talk about technical flows, mortgage hedging, dealer positioning, or issuance patterns, but none of those quite fit what you're seeing on the screen. The charts begin to behave strangely. Liquidity looks present but isn't actually available. Bid-ask spreads remain narrow, but depth evaporates. Markets appear orderly, yet every trade feels heavier. And then swap spreads start collapsing with a speed that dose and T match any of the old narratives. This is the turning point. The transition from normal to structurally unstable. The boundary where the market's visible story and its hidden mechanics diverge. Most people never notice this shift because a dose and T show up in prices first. It shows up in the relationships between prices. A treasury auction clears, but the repo rate doesn't respond. Corporate spreads remain calm, but swap spreads tighten. Volatility indices stay low, but dealer hedge ratios spike. The market is whispering that something is changing in its foundations, but the surface looks deceptively still. This is the moment when swap spreads stop behaving like a market metric and start behaving like a pressure gauge. And every crisis has followed this exact pivot. The twist, the part almost no one talks about, is that swap spreads do not collapse because of changes inside the swap market. They collapse because something outside the swap market is breaking. The spread is not the source of fragility. It is the first instrument sensitive enough to detect it. The mechanism behind the twist hides in dealer balance sheets, in the architecture of collateral transformation. in the limitations imposed by post-2008 regulation, in the invisible constraints shaping how banks absorb risk. Here is the realization that shocks most people when they encounter it for the first time. Swap spreads flip because treasuries stop behaving like risk-free assets. Not in terms of credit, the U.S. government isn't defaulting, but in terms of accessibility. When balance sheets tighten, when regulatory ratios bind, when repo markets seize, dealers can no longer intermediate treasuries with the freedom the system depends on. Suddenly, the safest asset in the world becomes hard to move, hard to finance, hard to reuse. It becomes safe in theory, but scarce in practice. And that scarcity breaks the logic of the spread. Think of it like this. If the entire system is built on the assumption that treasuries will always be liquid, but one day that assumption fails, then everything tied to treasuries, swaps, futures, repo clearing, derivatives hedging, must recalibrate instantly. Not gradually, instantly. This recalibration is the twist. It is the moment when swap spreads compress for reasons that have nothing to do with interest rates or growth or credit. They compress because the structure holding the system together is shifting. The market knows this. The smartest desks know this. The Federal Reserve certainly knows this, but the public rarely understands what this shift means. It means the denominator of global finance collateral is under stress. And when collateral is under stress, everything built on top of it becomes fragile. Funding chains shorten. Dealers reduce balance sheet usage. Hedge funds delever. Derivative hedges break down. Banks stop intermediating. Market depth thins even as prices appear stable. The surface remains glossy, but the foundation is cracking. This is why swap spreads often flip before anyone sees a liquidity crisis. They are sensitive to balance sheet withdrawal long before price volatility appears. They reveal the system's vulnerability while everyone else is still focused on equity charts and economic forecasts. The twist becomes undeniable when you see markets doing something that should be impossible. Treasury yields falling, but swap spreads tightening. Demand for safe assets rising, but repo rates spiking. Volatility staying low, but liquidity evaporating. Risk sentiment appearing calm, but collateral usage collapsing. It is the inversion of logic that marks the transition from stability to fragility. The moment when the market stops acting like a free-flowing system and starts acting like a machine with sand in the gears. The moment when the narrative, the public narrative, becomes irrelevant. Because from this point forward, the behavior of swaps, treasuries, and repo isn't driven by news or expectations or speculation. It is driven by constraints, hard structural limitations that cannot be talked away by optimism or policy guidance. The system has already turned. The spreads are already telling the truth, and that truth is simple. When swap spreads tighten sharply, something in the collateral mechanism has already broken. When swap spreads flip negative, the system is no longer functioning normally. At the core of every modern financial shock lies a mechanism so mundane and technical that most people never think to look at it. Yet so essential that the entire system depends on it functioning perfectly. The transmission between collateral, balance sheet capacity, and the synthetic world of derivatives. And to understand why swap spreads tightened, why they compress toward zero or even slip below it, to have to step into this mechanism the same way you would. Step into the dim, humming engine room of a massive ship. Slowly, quietly. Realizing with each breath that the noise on the surface is irrelevant compared to the machinery grinding beneath your feet. Because swap spreads are not merely the difference between a treasury yield and a swap rate. They are the coded message emitted by the system when the invisible gears inside it begin to strain. And that strain always begins in the same place. With the question of who still has the balance sheet capacity to hold collateral when the market is tightening around them. Banks do not lend because they have deposits. They lend because they have room on their balance sheets. They do not intermediate treasuries because they like the yield. They do it because their internal constraints allow them to. They do not arbitrage swap spreads because they believe in textbook efficiency. They do it because their risk divisions tell them there is still space, still flexibility, still a margin of safety within their regulatory boundaries. But the moment that space shrinks, the moment their internal ratios tighten even a little, the entire ecosystem begins to distort. Dealers step back, repo markets thin, collateral transforms more slowly, and the arbitrage that keeps swap spreads anchored breaks in silence. You rarely see it happen from the outside. The surface stays calm, orderly, almost peaceful. Yet inside the machinery, the pressure begins to build. Treasuries, in that sense, are not simply government bonds. They are the bloodstream of the global financial system. They are moved, removed, borrowed, lent, sliced, pledged, repledged, transformed into liquidity, converted into cash, and used as the foundation of almost every major funding chain in existence. The world imagines treasuries as safe because they are backed by the United States government. But traders know the real reason they matter, because they can be turned into money instantly through repo. And that turning a simple-looking overnight loan depends entirely on whether someone is still willing to take them onto a balance sheet. This is where the truth becomes darker. When collateral demand surges, when investors panic, when margin calls rise, when variation requirements intensify, the value of treasuries is no longer just about yield. It becomes about their ability to satisfy obligations within the system. They become the oxygen tanks of the financial apparatus. But oxygen is only useful if someone can deliver it. And that delivery depends on balance sheet space that is already shrinking. When collateral scarcity intensifies faster than balance sheet capacity expands, swap spreads tighten because the system no longer has enough hands to carry the weight of collateral through its funding chains. Treasury yields fall from panic buying, but repo markets become unstable, and swaps anchored by synthetic hedging flow stop tracking those yields. What looks like a simple compression is actually the sound of the collateral engine choking. If you want to understand the sensitivity of swap spreads, go to the repo market. Repo is where treasuries become money. Repo is where leverage is born. Repo is where liquidity is manufactured every night and unwound every morning. According to the Office of Financial Research, the Treasury repo market processes trillions of dollars in daily funding. According to the buys, hedge funds obtain the majority of their leverage through repo. And according to the Federal Reserve's own primary dealer statistics, dealer balance sheet constraints limit how much repo financing can be provided at any time. Combine those three realities and you reach a single, unavoidable conclusion. Swap spreads compress whenever repo markets signal stress before the wider world sees it. The September 2019 repo spike, when overnight rates suddenly vaulted to 10%, was not an accident. It was the visible shock of an invisible tightening that swap spreads had been hinting at for months. The March 2020 Treasury market breakdown was not chaos out of nowhere. It was the final stage of a balance sheet contraction that had already begun deep inside the collateral system. And in both cases, spreads tightened first. They tightened because repo was losing its grip on treasuries long before the headline crisis began. The real bridge between treasuries and swaps is not the market itself, but the dealers who stand between them. Dealers are not passive intermediaries. They are the gravitational centers around which liquidity orbits. When they have balance sheet capacity, the system breathes. When they do not, the system suffocates. Regulatory frameworks, such as the Supplementary Leverage Ratio (SLR) and the Liquidity Coverage Ratio (LCR), were meant to make the financial system safer, and in many ways, they have. But they also force dealers to hold capital against Treasury inventory, meaning they can only absorb so much supply. Since Treasury issuance exploded past $20 trillion while dealer inventories stagnated around a few $100 billion, the imbalance between collateral supply and balance sheet absorption became structural. Swap spreads responded the only way they could, by compressing. They were not mispricing risk. They were revealing it. They were reflecting the fact that the system could no longer perform the arbitrage that once kept synthetic and physical rates aligned. Mandatory central clearing after 2008 changed the game even further. Swaps used to be bilateral, flexible, and dependent on dealer negotiation. After Dodd-Frank and Basel III, swaps became standardized exposures that required variation margin via clearinghouses. The market now depended on treasuries not just as collateral for repo, but as collateral for swaps themselves. Every shock, every hedge, every risk recalibration flowed through the clearing ecosystem, amplifying collateral demand. In a world where collateral is the lifeblood of everything from derivative hedges to margin calls, spreads compress because treasuries become too essential to move freely. They are hoarded, locked, trapped inside margin requirements. Swap rates remain anchored because clearinghouses keep them orderly. Treasury yields become erratic because the collateral mechanism behind them begins to buckle. The strangest moments in financial history: 1998, 2008, 2011, 2019. 2020 are all remembered for their headlines, but their real story is the divergence between synthetic and physical markets. The LTCM crisis widened spreads because the system was losing the ability to warehouse positions. The global financial crisis inverted spreads because treasuries became impossible to intermediate. The debt ceiling crises compressed spreads because collateral uncertainty overwhelmed traditional safe haven behavior. The repo spike tightened spreads because balance sheets had already contracted. The pandemic flipped spreads violently because treasury markets broke under their own weight. And in every case, swap spreads were the first to move, not because traders were fearful, but because the architecture of the system was shifting. To understand the deepest logic behind swap spreads, you must think in terms of constraints, not prices. The swap rate is shaped by counterparty risk, liquidity premiums, hedging flows, capital requirements, and clearinghouse margins. The treasury yield is shaped by risk-free curves, liquidity premiums, collateral scarcity, dealer capacity, and repo conditions. When swap spreads tighten, it is because the weight on the treasury side of the equation has become too heavy for the system to carry. When they flip negative, it is because the collateral engine beneath the treasury market has reached a point of dysfunction that synthetic markets cannot mimic. A swap is an agreement. A treasury is a key. One can be repriced instantly. The other requires movement, custody, and funding. As soon as those movements become difficult, the spread collapses. Inside the largest treasury shock of recent memory, the March 2020 breakdown, this truth became undeniable. Treasuries, normally the most liquid asset in the world, saw bid-ask spreads widened by more than a factor of 10. Dealers refused to buy. Hedge funds were forced into margin unwinds. The Treasury basis trade, estimated at over $600 billion by the BIS, collapsed under the weight of repo instability. As basis trades unwound, treasuries were dumped into a market with no balance sheet capacity left to absorb them. Yields rose where they should have fallen. Repo rates spasms. And swap spreads compressed to some of the lowest readings on record. Not because the world doubted treasuries, but because the plumbing carrying them had failed. This is the underworld pattern that repeats every time. When spreads tighten, balance sheets are shrinking. When spreads flip, balance sheets have already failed. The spread becomes the language of the system, telling anyone who knows how to read it that the machinery no longer has the capacity to process the flows moving through it. It is not pricing fire, it is pricing friction. And friction in a system that depends on smooth collateral transformation is the true precursor to crisis. Swap spreads do not warn you about recessions, credit defaults, inflation waves, or geopolitical shocks. They warn you about something far more fundamental. The moment when the collateral that holds the system together becomes harder to move, harder to fund, harder to transform. They warn you when the oxygen tubes are bending. They warn you when the machinery is running hotter than it appears. They warn you when the system is preparing to transmit stress through channels most people do not even know exist. And if you watch them closely enough, you begin to see the pattern that insiders have trusted for decades. Spreads tighten before the crisis, because the system tightens before the crisis. That is the meaning of swap spreads. That is the forbidden architecture beneath their movement. And once you see the logic, you cannot unsee it. Swap spreads are not about pricing interest rates. They are about revealing the strain inside the hidden mechanisms holding global finance together. And when they begin to compress, the system is already telling you that something deep below the surface has started to shift, and that the shift will eventually force its way into the open the same way pressure in unseen pipes always does when the building above them becomes too heavy to bear. In the end, the danger hidden inside swap spreads has nothing to do with the numbers themselves. It is not the level, or the chart, or the magnitude of the move that matters. It is the story the system is telling through that movement. A story whispered from inside the collateral engine, long before anything on the surface looks wrong. Most investors don't hear it because they don't know where to listen. They focus on headlines, central bank speeches, earnings cycles, and macro forecasts. But the truth, the part that only emerges when you stand close enough to the machinery to feel its heat, is that every tightening spread carries the same quiet message. Liquidity is becoming harder to create, and the system can no longer carry its own weight without strain. It is not fear that moves first. It is not panic. It is not loss of confidence. It is the slow, silent withdrawal of balance sheet capacity, the system's willingness to hold collateral, finance positions, and intermediate risk that begins disappearing before anyone sees the consequences. This is why crises always feel sudden to the public, but inevitable to the people who watch the pipes. Before any crash, before any liquidity freeze, before any violent repricing, there is always a moment when the structure stops behaving normally, even though the surface still looks calm. Dealers remain open, but participation thins. Treasury auctions still clear, but the quality of bids changes. Repo rates appear stable, but the depth behind them evaporates. Swaps continue trading smoothly, but their relationship to treasuries begins to twist. And the spread, this narrow, easily ignored gap between two rates, becomes the clearest reflection of the internal misalignment building beneath the system. You won't see the break from inflation reports or GDP updates or unemployment numbers. You will see it in the way collateral stops moving the way it should. That is the real warning, not the inversion itself, but the shift in the system's behavior that makes the inversion possible. Once swap spreads tighten into dangerous territory, the architecture of the market enters a phase where shocks transmit more violently, where liquidity behaves less predictably, and where even small imbalances can cascade into larger fractures. And once spreads flip negative, you are no longer dealing with a market under stress. You are dealing with a market that has lost one of its structural anchors. There is no historical example where deeply negative swap spreads occurred in a healthy system. Every episode has been tied to the same underlying condition, a system that temporarily cannot transform collateral into funding as easily as it needs to. It is a condition that resolves only when balance sheets expand, either voluntarily, through dealer risk-taking, or forcibly, through central bank intervention. This is why the Federal Reserve always steps in, not because yields move, but because the internal machinery has begun to seize. Every emergency repo facility, every balance sheet backstop, every asset purchase program is ultimately aimed at restoring the exact mechanism that a tightening swap spread is revealing as broken. Most people think central banks target rates. Insiders know they target functioning, the ability of the system to transmit liquidity without interruption. When that ability breaks, the spread is the first piece of evidence. The Fed responds later because their mandate forces them to wait for visible signs, while the spread reflects the invisible ones. But by the time the visible signs appear, the structure has already shifted. The warning embedded in swap spreads is not fatalistic. It is not a prediction of collapse. It is a reminder that systems rarely fail because of the events described in headlines. They fail because of the slow, silent accumulation of friction inside their foundations. If you learn to see that friction, if you train yourself to hear the sound of a pipe straining in the dark, then you begin to understand markets not as a loose collection of prices, but as a living architecture, one that breathes, tightens, and signals long before it breaks. And the spread, ignored by most, becomes the clearest voice in that architecture, calm when the machinery is balanced, uneasy when alignment slips, tight when stress is rising, and negative when the system has crossed a threshold it was never designed to cross.